I'm Emily Chang, and this is the best of Bloomberg Technology, where we bring you all our top interviews from this week in tech. Coming up, Apple turning in a solid quarter with revenue, profit, and forecasts all painting a strong, stable picture ahead, and Wall Street applauded. We'll bring you the highlights. Plus, Facebook holds its developers conference. The biggest headlines from F8, including plans for the social networking site to become matchmaker for its billions of users. And Tesla gets testy. CEO Elon Musk shocks analysts and investors after he refuses to answer questions on Model 3 production, margins, and cash burn. But first to our lead and Apple's blockbuster second quarter numbers. Some of the main takeaways. CEO Tim Cook says the smartphone market is not saturated, and there are 500 million feature phones out there that will get traded up for smartphones like the iPhone. Meantime, Apple's services business had a sensational quarter, and the business is on course to double revenue by 2020. And for investors, Apple will continue to prioritize buybacks over dividend increases because the company thinks shares are cheap. Apple's stock shot up on the news. We delve deeper into what it all means on Tuesday with Julie Osk, Vice President at Forrester Research and Bloomberg Technology's Executive Editor, Tom Giles.
The big picture take on these numbers is it's really good. I mean, estimates are what they are. They're estimates. The numbers are up dramatically, same quarter over last year. And, you know, I think overall the numbers are good.
What about the ASP, though? Does that concern you that people are potentially buying more of the cheaper price phones than the higher price phones? And by the way, I did just get off the phone with Apple CEO Tim Cook. And in general, about concerns around the iPhone X, he said it was the most popular iPhone every week in the quarter. It's the first time since we split the line with the 6 and 6 Plus, and the first time since then that the top iPhone has been the best-selling. I think that's an incredible result if you think about it. I do not have concerns about the price. I think it's priced for the value that it is. Incredible product with lots of leading-edge innovation that sets up for the next decade. Julie, do you have concerns about the ASP dropping?
Yeah, so I wouldn't be concerned, I think, for a number of reasons. I think, one, you know, smartphone adoption in mature markets is plateauing, and these devices are very expensive. It's more and more like buying a PC, so the upgrade cycles are slowing, and it's going to be harder and harder to convince consumers to continue to upgrade their phones every 2 years. And so I think that's a very, you know, it's in line with what my expectations would be. The reasons to upgrade my phone are becoming more and more subtle. It's less about the camera and the screen and the nifty features, and it's more about the subtleties that artificial intelligence fuels.
So I did ask him about the ASP dropping, and he talked about how, you know, from last quarter to this quarter, they always take out some inventory, and that inventory is often the higher priced inventory. Tom, you know, what is your top line takeaway, given all the fears that, you know, smartphone demand is slowing, that these results wouldn't be so great, but that they have, in fact, held up and in some cases beat analyst estimates?
Yeah, there was a lot of pessimism coming into this quarter, and it's hard to find a lot of fault in what they said. We haven't talked a lot about this yet either, but they talked about this buyback of $100 billion. So they've got this cash. People have been saying, okay, it's basically the size of a Netflix. So that's a lot of money to put in the hands of shareholders. But I think the fundamental story at Apple is that it has held up very, very well, despite a lot of pessimism, despite a lot of evidence in the market that the smartphone boom is ending. I don't think that fundamental story changes. But Apple is doing very well in spite of it. They talked about grabbing share. They've talked about strength in China, the world's largest smartphone market, a market where competitors have been taking share from them. It remains to be seen exactly how things panned out with those competitors. We'll know more in the coming weeks. But for now, they've just been holding up very, very well. So if there's suffering to be done as the smartphone boom slows, it's not really happening for Apple. I think another thing to bear in mind is if you look at the rest of this year, Apple realizes that people do want lower priced lower priced devices. And so, as Mark Gurman has reported, you're going to see later in the year the introduction of a lower priced device that has a lot of the functionality that the currently high priced devices have. So they recognize that they can't let go of that lower end of the market. They recognize that not everyone wants to spend $1,000 on a smartphone.
Now, Apple's Tim Cook on the call right now. We are listening in, and I do want to talk a little bit about services, which grew 30-some%. Obviously, this is powered in part by Apple Music. We talked a little bit about how he thinks the real competition is not Spotify or any other music service, but it is convincing, billions and billions of people around the world to pay for a music subscription service. They do now have 40 million paid subscribers, 8 million subscribers in trials. Julie, what do you think when you look at these services numbers and you break them down?
Yeah, so I think the first thing is, the services revenue is up by over 30%. But I think as we look forward, right, when we talk about the notion that smartphone sales are going to plateau, Apple does need to look at its other products for growth, and it does need to look to services. And I think, it's very solid growth off of a small base, but we're also going to see the peak of apps here so in the near future. And I think Apple's going to have to look more to its services and its subscriptions, as well as things like Apple Pay for future growth. And I would expect that number to get much bigger over time if Apple's going to sustain its growth.
That was Julie Osk, Vice President at Forrester Research, and Bloomberg Tech's Tom Giles. Well, Twitter and Walt Disney have signed an agreement to create live content and ad opportunities from across the entire Disney portfolio. According to an emailed statement, Twitter and ESPN will announce specific live shows as part of the deal. The news sent Twitter shares up as much as 6% in Monday's session. Bloomberg produces TikTok, a global breaking news network for the Twitter service. Meantime, the political consulting firm at the heart of the Facebook data manipulation scandal is shutting down. In a statement released Wednesday, Cambridge Analytica says it filed applications to begin insolvency proceedings in the UK. The company cites, quote, numerous unfounded accusations about its role in the Facebook fallout as a major reason for ceasing operations. It says it's being vilified for activities that are not only legal, but generally accepted as a standard component of online advertising. Still ahead, after several false starts, T-Mobile is buying Sprint for $26.5 billion in stock to take on Verizon and AT&T, though some still fear the deal will be blocked. We're going to hear from T-Mobile CEO John Legere next. Plus, this week we were live from the Milken Global Conference. We'll hear from Thrive CEO Arianna Huffington next, talking about her mission to transform corporate culture and her goals at Uber. This is Bloomberg. Shares of Sprint tumbled more than 10% on concerns that antitrust regulators may reject T-Mobile's agreement to buy the company for $26.5 billion. The deal would reduce the wireless industry in the U.S. to 3 major competitors. T-Mobile and Sprint are hoping the combination would let them get a jump on Verizon and AT&T when it comes to building a next-generation network. Bloomberg's Vonnie Quinn sat down with T-Mobile CEO John Legere Monday to talk about the deal. Take a listen.
What we've got, and today's the start of doing 2 things. One is talk about this deal, talk about the value to shareholders. And the second is talk about why now and how it's going to get approved. Those 2 things together will drive shareholder value. This deal, you said $26.5 billion. It's actually a $145 billion enterprise value combined company. What we're going to have starting from day one is $75 billion of top line revenue, $55 to $57 billion of service revenue that's going to grow 2 to 4% compound annual. EBITDA will start at 22 to 23 billion, and it'll be up to margins of 55 to 57%. The fun part is the synergies are $43 billion with a $6 billion run rate, and the cash flow by 2025 will be 16 to 18 billion. So if you're a shareholder, this has huge value. Now, what's happening is people are asking the question, why now, and will it get approved? Now, that's my job starting day one. I am so confident of the plan that we've got. It's in 3 buckets. Why Washington, and I'm going to be there right after we finish. I'm going down there, and I'm going to be there quite a bit. So what we got is this: 3 points. What's different now? 5G. 5G is an imperative. The nation's leadership in 5G is at stake. We've fallen behind to China, and T-Mobile and Sprint together is the only company that can change that. So 5G is critical for the country. We're going to change that. Second, the Un-carrier. We're going to supercharge the Un-carrier. What we've said is that customers can look forward to a broader range of service, more rural competition, more broadband competition, lower prices, and last of the three, jobs will go up.
Right.
So that's why it's going to get approved. And when that happens, the shareholder prices.
So these are the three pillars of what you're going to pitch to regulators.
Right.
A job-positive merger.
Yep.
You said 1,000 jobs in the next 18 months alone, right? Benefits to the consumer, particularly the rural consumer. And we know the administration has already signed an EO on broadband. So that's something squarely in the administration's court. And fending off China and Korea. I like how you threw Korea in there on 5G.
Yep.
Will that be enough to sway a regulator that has really only given the go-ahead to one media deal? The others had a lot of trouble.
Listen, the statistics are our leadership as a country in 4G spurred so much innovation. By the way, the 2016, there was $3.3 trillion globally in the mobile economy. It was driven by what we did. Uber, Snapchat came out of the 4G leadership. Facebook, Amazon, these companies grew because of. Now, in 5G, right now, what's going to be critically important, we're going to invest $40 billion over the first 3 years. We're going to take the 2.5 gigahertz spectrum from Sprint and the 600 and create a mobile layer that's going to drive this leadership. We expect what we do will then force AT&T and Verizon and others to invest significantly. Because what's happening right now, we talked about this last time, this millimeter wave deployment that Verizon and AT&T is doing, how about this? Do you know that if they wanted to do that nationwide, including rural America, it would cost $1.5 trillion. So it's a scam.
That was T-Mobile CEO John Legere. Now to the Milken Global Conference, where we caught up with LA Clippers owner and former Microsoft CEO Steve Ballmer. We talked about his outlook on big tech. Ballmer says he is optimistic about Facebook post-earnings. Take a listen.
If you just looked at last quarter's results, it would be hard to say it's too late. They still have a lot of momentum in their business and their user accounts. I certainly don't think it's too late, and they're smart people. I've spent a lot of time over the years, a good amount of time with both Cheryl and Mark, and I think they'll be very resilient.
And Ballmer explained why he sold his roughly 4% stake in Twitter.
I actually sold my Twitter stake.
You did?
Yeah, I sold
all of it.
I'm sure I own some in index funds, but I did. I decided, A, I'm not really excited as a profession to be an investor. Great thing to do, but probably not for me. And B, the price looked pretty good.
While at Milken, we also caught up with Thrive CEO Arianna Huffington. She has been touring the globe on a mission to transform corporate culture. Huffington spoke about how much progress she has seen and where she thinks companies need to do more.
There is tremendous progress because finally companies are recognizing that it's not about culture trumping business imperatives, but about culture accelerating business imperatives. That culture is now seen more and more as absolutely essential for the success of a company. At Thrive, we call culture the company's immune system. If the company's immune system is compromised, it's going to be much harder to deal with problems which are always inevitable, to be able to see disruptions, to see the icebergs before they hit the Titanic. So culture is no longer the exclusive province of HR.
Now, a group of former Facebook and Google employees have started the Center for Humane Technology to warn about the dangers of tech addiction and pressure companies to make some changes. What would you like to see from Apple, Facebook, Google?
Well, the first thing that I would like to see is from individuals. I think there are three ways we can affect change that is absolutely needed in terms of our relationship with technology. And the first one, the one we are focusing on, is what are people doing? We are not powerless. We have agency. So we've created, for example, a Thrive app that helps people put their phone in Thrive mode when they're having dinner with their family or doing deep work. That gives us a social media mirror, of our consumption of social media, of games, of all apps, so that we know how much time we spend aimlessly scrolling. And then, of course, there are things companies can do to make it less easy to be addicted to our phones, to make it less easy to lose ourselves.
So Facebook, for example, has been in a storm of controversies. Among them, you've got former Facebook employees saying it is addictive. They're worried about the impact on children. Are you worried about that? And should Facebook be doing something more to make itself less addictive, which is also potentially undermining its business?
Well, we have the data. It's not a matter of opinion anymore. We have the data that shows that excessive use of social media is having an impact on people's mental health, teenagers especially. Depression, anxiety are escalating, suicides. We see this as a global phenomenon. Yes, absolutely, companies have to do more to make their algorithms less addictive. But also individuals have to do more. That's why we constantly stress what individuals can do, because otherwise, if we hold our breath and wait for companies to do something, we're going to suffocate.
Have to ask you for an update on Uber. I know that you've been very optimistic about Dara Khosrowshahi's tenure. When you look ahead to the year at Uber, what are 3 goals you would like to see him meet?
Well, I love his prioritizing safety. I think this has been a great initiative to make safety of riders and of drivers a big priority for Uber in the year ahead. The second priority that he has established is to make Uber a true mobility company, buying Jump, the bike company, getting more engaged with public transportation. And the third is culture, the shifts in cultural values and the work that remains to be done around inclusion and diversity. These 3 have been the big established priorities for the year ahead.
14 women who allege that they were sexually assaulted by Uber drivers have signed an open letter asking Uber's board to allow their lawsuit to proceed in open court. What's the response to that going to be?
So there is a board meeting that we have next week where this is going to be discussed and where our general counsel is going to give us all the arguments that we need to consider.
Still ahead, Tesla's circus of a conference call shakes confidence in Elon Musk. Where the company goes from here. And if you like Bloomberg News, check us out on the radio. Listen on the Bloomberg Radio app, Bloomberg.com, and in the U.S. on SiriusXM. This is Bloomberg. Tesla CEO Elon Musk got testy with analysts after the company reported earnings Wednesday. Turns out Musk's responses to analyst questions overshadowed the company's results, which actually beat expectations. But then came what one analyst described as a truly bizarre earnings call.
Where specifically will you be in terms of capital requirement?
Next. Boring bonehead questions are not cool. Next.
Of the reservations that actually opened and made available to configure, can you let us know what percentage have actually taken the step to configure?
We're going to go to YouTube. Sorry. These questions are so dry. They're killing me.
Investors' response was swift and shares of Tesla plunged Thursday. Musk has built a reputation as a showman, ushering in new technology to the masses. But is the tide of public opinion turning? We were joined by Bloomberg's Dana Hull, who covers Tesla, and Romit Shah, analyst at Instinet, who currently has a buy rating on the stock.
It's a shame that the call went the way that it did. I thought the results were actually quite positive. I mean, Tesla showed quite a bit of progress on Model 3 production. They showed quite a bit of fiscal discipline. We see CapEx coming in for the year, and they're very close to profitability. And importantly, the company, reiterated that they do not need to raise capital this year. So, unfortunate the way the call went. I think that if it wasn't for that, the stock probably would have been up 5% instead of down 5%.
So, Dana, what do you think was going on here? Fairly promising results, and then he just kind of train wrecks the opportunity to explain them.
Exactly. I mean, the shares were actually up after the earnings hit, but as soon as he cut off the analysts, then it started dropping. And I think it was just sort of a level of dismissiveness of Wall Street that the street was really taken aback by. And then you saw the more he kept talking, the more the shares kept dropping, and then they've dropped further today.
And then you did have some analysts pushing back. Here is an extended version of that quote we brought you earlier on volatility. Take a listen.
I completely understand your frustrations, and I'm frustrated too on how myopic we are right now. They also say that great years are made out of quarters, and great decades are made out of years. So everyone's short-term focused in some ways, and volatility has a way of shaking people out, even that are strong and want to be there. And so, anything you can do to help in the near term on that, I think is helpful for the stock. That's it.
I mean, I think that if people are concerned about volatility, they should definitely not buy our stock. I am not here to convince you to buy our stock. Do not buy it if volatility is scary. There you go.
And yet, Romy, you still have a buy rating on the stock. Why?
Well, look, I think that this issue is temporary, and over the next couple of days, we probably won't even be talking about it. And we're optimistic about Tesla. They're growing. This is a multi-billion-dollar company growing at an unprecedented rate, and we see a path to positive cash flow and a valuation that is, would put the stock north of $400 over the next 12 months.
I want to push back on that a little, though, because over the last several weeks, we've been talking about Elon Musk's road tweets, a bad April Fool's joke. Minutes before this earnings call about Tesla, he's tweeting about his other company, SpaceX. Do you have any concerns about his state of mind?
I'm not in a position to comment on his state of mind. What I believe is that the number one thing as it relates to this company is production of the Model 3 vehicle. And if you look in the third quarter, they produced 200 vehicles. In the fourth quarter, they produced about 1,500 vehicles. In the first quarter, they produced almost 10,000 vehicles. And this quarter, we believe they'll produce over 30,000 vehicles. So the progress is tremendous. And once they get to around the summer months, we think that they'll be producing, around 5,000 cars per week, and they'll be profitable. And once they get over the hump on production and they turn a profit, I think the conversation is going to completely shift from free cash flow and the balance sheet to market opportunity. And if you look at this company, they're competing in a market that's about 100 million units. And they are just a very small fraction of it today with a tremendous amount of growth. So, we're optimistic about the company's product prospects. We're a big believer in the product. And in the long run, I think Elon Musk is going to be very positive for shareholders.
Dana, are investors worried about this kind of behavior despite the numbers?
Yes. I mean, the shares just started dropping once he started talking. I mean, that's phenomenal to me. And the shares were down further today. So I think people are concerned. I mean, whether, he probably said things that every CEO would love to say on an earnings call, but he just sort of broke the norms of convention. And when you are a publicly traded company that goes to the capital markets for fundraising, you don't treat analysts this way. I mean, especially publicly, he was berating them in a way that, I don't think there's been an earnings call quite this combative in a long time. People are comparing it to Jeffrey Skilling on Enron.
Bloomberg's Dana Hall and Romit Shah there from Instinet. Coming up, we continue our coverage from the Milken Institute Global Conference, speaking with Microsoft Chair John Thompson on joining Lightspeed as a venture partner. That is next. And a reminder, all episodes of Bloomberg Technology are live streaming on Twitter. Check us out at Technology, weekdays, 5 p.m. in New York, 2 p.m. in San Francisco. This is Bloomberg. Welcome back to the Best of Bloomberg Technology. I'm Emily Chang. Back to our coverage from the Milken Institute Global Conference in Beverly Hills this week. We spoke with Microsoft Chair John Thompson while we were there. Since taking over as chairman when Microsoft co-founder Bill Gates stepped down in 2014, Thompson has played an important role supporting a bid by CEO Satya Nadella to modernize the tech giant. Thompson also just announced he's joining Lightspeed as a venture partner, an early investor in Snap and Honest Company. We started there.
Well, Lightspeed, because they were investors in my last company, Virtual Instruments, and so I've known a number of the partners for the last 8 or 10 years. They tend to invest in areas that are very, very much of interest to me. And it's all around enterprise infrastructure-related technologies. And so security, infrastructure, storage, all of those things are things that I have invested in either personally or when I was running Symantec, we acquired businesses in that space. So this is an opportunity for me to keep learning and to hopefully help the Lightspeed team along the way.
Are you concerned about the potential for increased regulation and how it will impact tech companies, large and small, but really as big as Facebook, as big as Microsoft?
Yeah, I think the recent incidents certainly have raised the issue of regulatory oversight, and there may be some that will evolve, but I wouldn't let that distract me if I was the CEO of a tech company. It's all about executing against the plan that you have in place. I think there is an issue that looms on the horizon for us, and that's all around privacy. And how are we going to manage privacy in a different way in a world where everyone is connected and the amount of digital content being parsed from that connected world is really, really significant. And so something is likely to happen. I just don't know what or when.
What would you like to see tech companies do about privacy differently than they are doing today?
I think tech companies should respect the information about me or you.
But what does that mean?
That means they don't sell it, they don't share it, they do it in a way that's relevant to the needs of their business. Now, many of them make money off of ads, and therefore they have to kind of use that as a leverage point. But at Microsoft, we don't do that. We don't believe in that, and I think more and more tech companies need to think about what their policy should be around that issue.
So Facebook says over and over again they don't sell your data. They essentially rent it, though. And is there something fundamentally broken about that model?
I'll let Zuckerberg explain that to you.
So let's talk about the cloud, because 2 years ago you said you wanted Microsoft to move faster in the cloud. Where have you seen progress, and where would you like them to still continue to move even more quickly?
Well, I think it's part of the role of being the chairman of the board is to be impatient. And so my comment a few years ago was about that statement of impatience, if you will. The company's made phenomenal progress, phenomenal progress. Our commercial cloud business is doing very, very well. They've got a very, very strong IoT presence now, and they're doing a lot more in that space. And so
still behind Amazon
look,
in a big way.
Amazon was a first mover, and so it takes the second mover a little while to catch up. But I think we're making the kind of progress because our growth rate is certainly stronger than Amazon's at this point in time.
Should Microsoft be in acquisitions?
I'm sorry.
How bold should Microsoft be in acquisitions?
Well, that's a tough question. I think the company has an enormous amount of capital, and so they have the capacity to go out and acquire a lot of things.
Right, and extra overseas cash now as well.
Well, most of that cash is now back, and so the real question for Microsoft is not about the availability of cash to do acquisitions. It's more, how does an acquisition fit into what you're trying to accomplish? If you look at the Nokia deal, Steve felt very strongly about being in the mobile business, and therefore that was an important thing to do. If you look at the LinkedIn deal, Satya felt very strongly about being in the social media business, and LinkedIn has been a wildly successful transaction. So if we can do another LinkedIn, I'm all in.
So any areas in particular that you're interested in? I mean, obviously Nokia didn't work out. LinkedIn, you say it's working. We'll see, some time should pass.
Yeah.
But, where would you like to see them?
Well, I think anything that strengthens our relationship between our cloud and a broad network of users. So IoT, doing commercial cloud things that for financial services or industries that generally have not moved to the cloud, those are the places that represent big opportunities for us.
What should Microsoft be doing to advance more quickly in the emerging world of AI?
Well, Microsoft has a huge investment in AI and machine learning. And if you look at the most recent restructuring of the company, we allowed Harry Shum to continue to run AI as a research operation, but we also integrated many of the functional components of AI into the operating teams that are driving the revenue day in and day out. And I think what you're going to see is AI and machine learning become a prolific or important part of, if you will, every single platform that Microsoft and every company in the industry has. AI will be the future of technology for sure.
And do you see the negative side of AI, or do you think it will be more positive? And is it up to companies to be responsible in the same way we need to be responsible about data and privacy?
Well, I don't think any of us anticipated 25, 30 years ago that PCs would turn into what they've turned into. And we couldn't anticipate that, just as we can't anticipate what AI might do. But what we do know is that the digitization of the world is accelerating. And so AI is going to have a more powerful impact than we might have ever envisioned 2 or 3 years ago. And we will know in a few years just how impactful that'll be.
That was Microsoft Chair John Thompson. Well, Amazon is said to be prepping a move that could be a new threat to payment services like PayPal and card-issuing banks. The e-commerce retailer is offering to pass along the savings it gets on credit card fees to other retailers if they use its online payment service. This, according to people familiar with the matter. Typically, merchants using Amazon's service pay about a 2.9% fee, but a long-term commitment to the service could mean a lower negotiated price. Still ahead, Facebook says it is building its own matchmaking app, but longtime incumbent dating site Match.com says it's ready for a fight. That story ahead. Plus, just a month after its direct listing, Spotify reported earnings this week, leading to its worst stock decline in its short life as a public company. Why investors were disappointed next. This is Bloomberg. Shares of Snap tumbled after reporting earnings Tuesday. The company fell short of forecasts after rolling out a redesign of its main photo-sharing app, a move that turned off new users and held back ad growth. The company missed on 2 crucial metrics, daily active users and quarterly revenue. We were joined by Deborah Aho-Williamson, analyst at eMarketer, for full analysis. Deborah joined from Facebook's F8 conference in San Jose, California, which we will get to momentarily.
This was definitely a challenging quarter for Snap, no question. I think the big revelation, the big takeaway for me has been that not only are users upset at Snapchat because of the redesign, but now advertisers are concerned. And that is a big issue because Snapchat cannot stand to have any concern among its advertisers. Those people need to be strong and solid on Snap for sure.
So what's the solution here? I mean, what can Snapchat do, aside from revert?
Well, you know, there are a couple of positive things. I mean, I think that one of the great things about Snap has been and will continue to be the fact that its active users are very engaged. And I think keeping those users engaged is something that Snapchat's going to have to make sure they continue doing, in addition to adding new users. And on the advertiser side, I feel like they're doing a lot of smart things. They've transitioned towards a self-serve, a more programmatic advertising infrastructure. That's making it easier to buy ads on Snapchat, which also, I think, is helping them in the long run. But I think those advertisers need to be reassured that this is a company that is dedicated to making improvements, to keeping its users on board, and definitely keeping them happy. And so it's got some work to do.
Of course, the irony is not lost that you're at F8's Facebook's developers conference, and Facebook has, in many cases, copied some of Snapchat's features and ported them over to Facebook, ported them over to Instagram. Mark Zuckerberg there announcing a new dating service. I want to take a listen to what he had to say about it.
It's going to be in the Facebook app, but it's totally optional. It's opt-in. If you want, you can make a dating profile, and I know a lot of you are going to have questions about this, so I want to be clear that we have designed this with privacy and safety in mind from the beginning. Your friends aren't going to see your profile. You're only going to be suggested people who are not your friends, who have opted into dating, who fit your preferences.
Deborah, what do you make of this new service in the context of all the very, very big, important, critical issues that Facebook is dealing with right now, including data privacy, election meddling, fake news, harassment, and now a dating service?
You know what? The way you phrased that is exactly my response. I think they did a great job of turning people's attention away from some of these big issues, at least for temporarily. The dating app was definitely out of left field for a lot of people, myself included. It makes some sense, I think, because obviously Facebook's goal is to connect people, make them interact more, and certainly dating is a part of that. But I really don't know that this is something that anybody expected out of Facebook. It's quite surprising to me.
Is it something that could materially add to the bottom line? I mean, in a way, it's a surprise they didn't do something like this sooner, but then again, they didn't do something like this sooner.
You know, people have said that, yes, Facebook should have launched a dating app before. I do think it'll probably help their bottom line. Obviously, dating apps and dating companies have been very successful, Match.com being one of them, as well as others. This is a business that I think Facebook will get into and will take seriously. But I think the proof is in whether they can put those privacy safeguards around the dating service that they claim to. Things like being able to keep people's private information private from their friends, keep them safe from people seeing or interacting with them that shouldn't be able to do that. With all the privacy concerns swirling around Facebook right now, I think the dating app is the one that people are going to pay a lot of attention to and try to make sense of whether Facebook is actually able to maintain people's privacy at the same time that it gets involved in dating.
Thanks to Deborah Aho-Williamson there from F8 in San Jose. Staying on the earnings front, Spotify suffered its worst stock decline since becoming a public company, slammed by investors who weren't impressed with a 45% jump in subscriptions last quarter. Shares tumbled after the music streaming service said it reached 75 million premium users last quarter on Wednesday. And while the number matched Spotify's projections, it wasn't the breakout growth shareholders hoped for after its strong debut on the New York Stock Exchange last month. We spoke with Bloomberg's Caroline Hyde from London and Bloomberg's Alex Barinka in San Francisco for more.
I don't know if it's necessarily disappointment, but I think it might have a bit to do with how this company got public. You'll remember Spotify went public in a direct listing. They basically just said, hey, all of our existing shareholders can sell their shares now on the open about a month ago. Not as many holders sold as expected in the early trading. Now the stock is up 12% from its open price. I have a bit of a suspicion that the good old-fashioned profit taking is going on here. People are seeing this stock up at $170 today at the close. They're taking this opportunity to potentially sell off because, look, when I dig deep into the numbers, everything is in line. Everything's in line with company guidance. It's in line with analyst estimates. So I am left scratching my head a little bit as to what folks are really disappointed with, unless they're expecting really astronomical growth with users.
Well, and that's the question. Will Spotify have breakout growth of some kind in the future, Caroline, or is this the norm? Now that they have gotten to this side, will growth only sort of plateau?
Yeah, well, growth, wasn't really plateauing. If you look at premium subscribers up 45%, they've promised to continue this sort of growth of about a third in terms of premium users. Monthly active users continuing to grow about 30%, although that's what they're promising for the second quarter. This is a company that's going to continue to deliver as it promised. And my mind boggles slightly. We got these numbers that they said were expectations for Q1 2 weeks or less than that before Q1 was over. What did they expect? That they were suddenly going to ramp up user base phenomenally in the last couple of days and be able to punch the lights out into these particular expectations? You would think that potentially that would be market manipulation in some way. So they really had to live up to expectations. But analysts clearly either have decided that they wanted to see a little bit more, they wanted an under-promise and over-deliver, or indeed many of the shareholders are indeed taking profit, as Alex says. But I think there are heady expectations from analysts going forward. We've got plenty of buy ratings out on this stock. If you dig into the Bloomberg analyst recommendation, it's my favorite one if you look at the Bloomberg. And you can see you've got hardly any sells. I think you've just got one sell out there. You've got 12 buys. You've got an awful lot of holds on this particular stock. And the price target is getting close on where the price currently is. But many of these banks are saying, look, buy into this stock because of the subscriber growth. It's just at the beginning. That's what Morgan Stanley says. 1.3 billion smartphone users. Well, they've got some 75 million premium users and some more in excess of 170 million users in general. You've got plenty of room to grow, as, of course, Tim Cook was telling you for the rival Apple.
Shares still down, though, more than 6.5%. I did speak to Tim Cook before the earnings call yesterday about Spotify as the other big competitor now in the streaming music race. It certainly has turned into somewhat of a two-horse race globally. And I asked how worried is he now that Spotify is a public company, that they are posting the kind of growth that we're talking about. And he said, I see it differently than perhaps everybody else sees it. If you take all the streaming services in the world and add up subscribers, you get a very small number relative to the world population. So the big challenge is not competition with each other. It is convincing a lot of people that don't subscribe to a streaming music service to subscribe to one. And that's where the big opportunity is. I think we're in a great position to do that. Certainly a great way to spin, but do you buy it?
Potentially. I mean, remember, Spotify is the market winner. It's a nice thing for Tim Cook to say as the horse who's perhaps behind in the race, but where I see a bit of traction with what Spotify's been doing, if you look back in the past month, they've minted a deal with Hulu. They're packaging their music subscription with Hulu subscription video, and they're selling that now as a combined premium offering. So when you think about the generation that it makes sense for them to be targeting, these smartphone users, folks who are used to perhaps cutting the cord and having a slew of different subscription services, that take from Tim Cook does make sense. Whether or not Apple's winning, it seems like they might need a bit more content, which again is where you've seen Spotify really try to push in outside of just music into podcasts. And now with this tie-up with Hulu, they're pushing video in the Spotify app. Right now, you can watch Hulu's shows right now.
Well, and interestingly, Tim Cook also talked up Apple's exclusive video content, exclusive radio content, exclusive interviews that they do with artists. You know, Caroline, are there particular global territories or regions that Spotify expects to grow more, in particular?
China, I think, is where analysts are really focusing. Remember, one of their biggest investors is Tencent, and they think that therefore a deal can be done with Tencent Music. They could really grow their focus over there. I was interested in the breakdown of premium users at the moment. The bulk, about 40%, are here in Europe. About a third is over with you in the US. But then it's Latin America, and then it's the rest of the world. I think you will see more emerging markets. We saw Israel open up in March. You saw South Africa open up in March. We are going to see an expansion territorially. And as you say, more innovative ways of cashing in and making money.
That was Bloomberg's Caroline Hyde and Alex Barinka. Still ahead, how Xiaomi went from has-been to the world's biggest IPO in years. This is Bloomberg. This week, Xiaomi filed for an initial public offering in Hong Kong, kicking off a process that's expected to raise at least $10 billion. The IPO could be the largest since Alibaba in 2014 and may bring in a value of $100 billion on the 8-year-old company. The Chinese smartphone maker said revenue surged 67.5% in 2017, a blistering pace of growth that will help it take on Apple and Samsung. We went live to Hong Kong Thursday for more, where we were joined by Bloomberg's Stephen Engel.
Xiaomi was an incredible success story when it was founded in 2010. I remember first interviewing Bin Lin, the co-founder, and also Lei Jun back in 2012, one of the first foreign journalists to get an inside look at this booming company. We had no idea it was going to become this large, and they really were kind of a victim of their own success. Lei Jun became kind of a rock star, as you said, being compared to Steve Jobs in China. Actually, he said he didn't like to be compared to Steve Jobs. He said he was more like Jeff Bezos. Anyway, they had an over-aggressive expansion plan. And, you know, of course, as you know, they hired Hugo Barra away from Google. They really expanded very fast. But then some other cheaper competitors came along, kind of stealing their business model of online distributing the handsets. And they lost their way a little bit. The growth went down into the single digits. But Lei Jun has really turned things around ahead of this IPO now, which could be listed here in Hong Kong by June. He spread out to India. I think they're the #2 Indian handset vendor right now. And they went upper end as well, recapturing some of that blistering growth that they saw in the early days.
How does this set up the Hong Kong market to challenge New York as IPO king or queen?
Yeah, that's right, because, of course, Hong Kong did not allow dual-class share structure, which would allow the founders like Lei Jun, despite having a minority shareholding, they would still maintain control. Well, Hong Kong has changed those laws to capture what has been, of course, a hugely successful run of Chinese technology companies coming to market. But like Alibaba, as you mentioned, in 2014, taking their $25 billion IPO to New York because Jack Ma could keep control with the dual-class shares allowed in New York. But in Hong Kong, they didn't allow that. They didn't want to have those violations, or they saw the violations of corporate governance and transparency. But they have changed the laws. A bit controversial here because of Beijing's, the thought that Beijing was exerting more control. But Lei Jun and Xiaomi saw this as an opportunity to come here, maintain control of the company. And others are lining up as well. Didi Chuxing, the ride-sharing company, as well as Ant Financial of Alibaba, are looking to go IPO possibly this year in Hong Kong.
Big question looming whether this company can really convince U.S. carriers to sell their phones in the United States and, not only challenge companies like Apple and Samsung globally, but in this market. What's the read on that?
Yeah, I mean, that's going to be a tough one as well because, of course, we've been reading all these stories about the blocking of other network equipment makers, whether it's ZTE or Huawei in the United States. Xiaomi is going to use the proceeds of this IPO to look at international expansion. They have gone, as I said, successfully into India as the #2 vendor there. The United States would obviously be a stated goal, but it will be a tough nut to crack, obviously.
That was Bloomberg's Stephen Engel from Hong Kong. Now, last year, Alibaba's chairman promised that his Chinese e-commerce giant would create 1 million U.S. jobs. We spoke to Alibaba Vice Chair Joe Tsai to find out what a trade war would do to that pledge from the Milken Institute Global Conference in Beverly Hills, California.
This will actually kill a lot of jobs in America if there's a trade war, because the tit-for-tat trade tactics really will cause a retaliation. And in fact, in China, they have just put on tariffs on soybeans. It's going to hurt American farmers. I think we're in a context where we're seeing a huge market in China, and it's kind of ironic that the U.S. administration is putting on a trade war right now because there are a lot of consumers in China, 300 million. President Xi Jinping last year at Davos said that over the next 5 years, China is going to import $8 trillion worth of goods. Because of the trade war, they put the gates down because of retaliation. This is going to hurt everybody, and it's going to close off a lot of opportunities for producers in the United States.
Alibaba and Jack Ma have said that they plan to create 1 million jobs in the United States, but Jack warned that that may not happen if a trade war moves ahead. Are you pulling back on that? Will those jobs not be created if the president stays the course?
Well, Jack has said that we're not going to create 1 million jobs. We could possibly create 10 million jobs if the trade flows are open. But if there are trade wars, if there are opportunity for small businesses that are being shut off because there's a trade war, then the consequences could be quite severe.
So the jobs will not be created, is what you're saying?
Well, I'm not an economist and to work through all those ramifications, but certainly you would be creating fewer jobs than if there were no trade war.
That was Alibaba Vice Chair Joe Tsai. And that does it for this edition of the Best of Bloomberg Technology. We're going to bring you all the latest in tech throughout the week. Be sure to tune in on Tuesday for our extended sit-down conversation with Social Capital's Chamath Palihapitiya. We're going to cover everything from diversity in tech to Facebook and more. And remember, all episodes of Bloomberg Technology are live streaming on Twitter. Check us out at Technology Weekdays. That's all for now. This is Bloomberg.